Welcome back to STRAT this week. It's February 13th. My name is Mike Rarey. We are excited to go through what's been going on in markets, updates to our investment framework, and everything else macro. Joining me here today to help go through the data is newly minted senior analyst Spencer Yurkowitz. Spencer, welcome back.
Thanks, Mike. Yeah, a lot of love in the air. Happy Valentine's Day, although not a lot of love in the markets last week.
Oh, that was beautiful. All right, let's get right into it and jump into returns for equities.
Awesome, sounds good. So taking a look at the board for equities, you'll see stocks broadly holding their year-to-date gains. So large cap stocks and foreign stocks up about roughly 7% for the year. Small caps doing a little bit better at about 9%. But looking at that first column in the table, just what happened last week, pretty much a broad sell-off across all areas of the equity market. So depending on where you were, retracement from anywhere from 1% to 3% last week. And really the broad narrative for what's happened here is the market's starting to price in a higher level for the path of the Fed funds policy rate for the rest of the year.
Absolutely. And if we sort of give an update about something we spoke about last week, which was, where are these gains in the U.S. equity market coming from year to date? And last week, we gave an update on the types of companies that were leading the way higher. And they were generally lower quality companies that sort of were COVID darlings that since plenty of their business models have actually blown up. And they were heavily shorted. And so it didn't give us a lot of confidence in this rally we've seen year to date. And so we want to add sort of another tile to that mosaic. If we go to the next slide, the other thing that we've seen, very speculative behavior year to date, we actually saw record call option volume. So retail call option trading boomed post-pandemic with trading platforms such as Robinhood and retail investors able to sort of lever up their bets on meme stocks and other speculative positions through options. And believe it or not, we actually have surpassed that level of option trading. And why we bring this up, when there is a tremendous amount of call option volume, there aren't enough natural sellers of those call options to make a market for all that buying that's going on. And what essentially has to happen there is the call option dealers have to make the market. And what they do is they will create the call option, sell it to that retail buyer or institutional buyers in many instances, but then they have to hedge that position. And how do they hedge that call option they just wrote? Well, they have to buy the underlying stock. And what this essentially does is it magnifies any speculative bull market or bear market rallies like we're seeing right now, but it also can magnify any pullbacks as those option positions get unwound and dealers have to sort of unhedge, which means sell the stocks that they purchase as part of hedging their positions. So this just sort of speaks to, once again, why the year-to-date rally that we've seen in equities in our view is a lot of noise and not a lot of signal. And this is very similar to things we saw in a very high liquidity environment where they might be more sustainable. This is very unique to see in such a low liquidity environment. We unfortunately do not think this has legs in terms of keeping the equity market moving higher. So now that we sort of talked about what's going on under the hood in the equity markets, we want to switch over and speak to fixed income. So a rough week for fixed income. Spencer, you sort of already alluded what might be going on under the surface here. What else is going on?
Yeah, so similar results last week for fixed income as equities. So repricing in fixed income as the path of Federal Reserve rate hikes has been notably higher since the start of the year. And what that has done is broadly sent prices lower for most bonds last week. So still holding their year-to-date gains, but that shift in yields last week definitely leading to the negative returns across the board that you see here.
And then when we move into the alternative space, not a lot going on. Definitely some green in the energy sector. Spencer, what's going on there?
Yeah, so not a ton going on. The one narrative that we did see emerging last week within the energy sector was some news coming out of Russia they announced that they were going to be cutting their oil production by about 500,000 barrels, which is roughly 5% of their current production. So some repricing in the market there to account for the supply and dynamics going on if Russia were to cut their oil production.
And no doubt that move is retaliation for price caps that have been fully implemented across Europe and the US as well. So you mentioned multiple times how a repricing of the path of the federal funds rate really has started to drive here more recently equity and fixed income prices. Let's take a look at that repricing, and why don't you just walk through sort of what we're looking at here. Title of this chart, where did the pivot go? So explain what we mean by that, and sort of what's going on here. What are the dynamics?
Yeah, so when we talk about the path of the federal funds rate, what we can look at is the federal funds futures market to get a sense for where the federal funds rate is expected to be over different time horizons. So the Fed funds rate really got repriced last week, but it's been moving in the upward direction all year. So first looking at that blue line, that's where we were at the start of the year, the federal funds rate. So peaking out sometime in the June and July timeframe. And then you'll see cuts in the back half of the year. So that blue line coming down from about 5% down to somewhere around 4.5%. So that's where we were at the start of the year. And then if you look at the red line, that's where we are today. And what you have here now is the market's now pricing in that the peak in the Fed funds rate is going to be later. So sometime in the September timeframe, and not really cutting much, if at all, towards the end of the year, maybe one cut priced into the fourth quarter. So the story here really being that the Fed is going to keep rates higher than previously expected and to keep them there for longer than previously expected.
And yeah, a lot of this move from the blue to the red has really happened since that January jobs report was released. And that jobs report obviously was great news for the US economy right now in terms of reducing recession probability. But if you take the strong labor market in the US, combine it with the reopening in China and Europe avoiding recession, this is all good news for the global economy, but bad news in terms of the Fed's war against inflation. And so now you're starting to see everyone sort of coming to the realization that good economic news means the Fed's just going to have to hike more, and it's probably going to result in bad news later. So you start to see asset markets sort of price that in. And as we move from the blue line to the red line, I think it's important to talk about what are the implications for our liquidity forecast. So why don't we go there next?
Yeah, so in our liquidity forecast, liquidity being the growth rate of the money supply in the US, liquidity strongly driven by changes in the federal funds rate as the federal funds rate impacts monetary policy and monetary conditions in the economy. So what we have here, liquidity, our liquidity forecast, not a major change since the last update, still expecting liquidity to be low and slow in terms of growth. On the margin, though, the increase in the federal funds rate expectations really just suppressing any growth in liquidity expected for the next 12 months or so.
Right. And another reason why we think about this year-to-date rally, thinking, it's a lot of noise and probably not a lot of signal, because our liquidity implied fair value for the S&P 500 has actually gotten a little worse. It's now down to about 3,500 on the S&P compared to where we're sitting right now, somewhere above 4,100. So that's the biggest detachment from liquidity implied fair value that we've seen since the really strong bear market rally experienced last July. So, the Fed potentially hiking more, anyone hoping for a pivot, expectations for that pivot going down. And, we're starting to see the reason why the Fed might have to hike a little more if we look into our inflation forecasts. And Spencer, why don't you speak through the developments in our forecast for headline and core CPI that, week over week, and then even how these forecasts have evolved really over the past month and since the jobs report?
Yeah, since the past month or so, what we've seen is on the margin, inflation forecasts coming up or a little bit higher over the next 12 months. And what's really driven that has been the labor market just staying so tight. That strong January non-farm payrolls number, and wage growth is a very big component of inflation. So that driving some elevated forecasts over the next 12 months or so, as well as recession probability slightly down in the near term. We'll touch on that a little bit later, but that leading to slightly hotter inflation in the near term by about 30 basis points or so.
Exactly. So if you thought the Fed was going to be able to stop hiking rates at somewhere near 5%, but then you look at this inflation forecast and you see it start to come up, the 12-month out number to somewhere around 4% for core CPI, then you say, well, looks like the Fed can't stop hiking at 5%. They probably need to go a little higher. And so that's what the market's definitely pricing in. And what's interesting now is the Fed is potentially going to be hiking rates through August, September time period this year. And that's happening as we're seeing a very sharp slowdown in corporate earnings. And so this is something we sort of teased and provided some detail on earnings last week, but we wanted to provide a bit more of a historical perspective. So with this next chart, what we have is the S&P 500, and then in the green line, we have blended forward earnings per share. And Spencer, can you just speak to what we're seeing now? Obviously, that green line is headed down, and just speak to, where that's coming from and what we would need to see to feel more confident that we've sort of made a substantial or meaningful market bottom, and perhaps equities could come back up.
Yeah. So what we're looking at here, blended forward earnings per share for stocks in the S&P 500, and we know monetary policy works on a lag. It takes 12 to 18 months to really feel those effects in the economy. So we're just starting to see the early innings of that and its impact on earnings. So you'll see here that green line starting to turn over as earnings have started to turn down. So for the fourth quarter, we've got roughly 70% of Q4 earnings reported so far, but probably going to hear some pretty tough earnings numbers for the remaining of the quarter if we think through the impacts of monetary policy, liquidity on earnings and their impacts on businesses. And stocks generally do follow this trend as well. So for stocks to meaningfully find a bottom, we'd have to see earnings coming up again, or at least finding some room at the bottom, some ground to lay on there.
Exactly. We're very closely watching what are the expectations for earnings 1 year from now. We want to see those stabilize and even start coming back up before we can feel really confident that this momentum we've seen here recently is something that's tangible and is more signal. So we want to try to sort of bring all this together. So we've talked about the Fed. They need to hike more than everybody previously expected because the labor market is stronger than expected. They're trying to loosen the labor markets, and they're doing that all while earnings are coming down. So, in an effort to sort of bring all that together, we'll look at the next slide. And it really asks, is a profit recession required in order for the Fed to win the war against inflation? And how this relationship basically works, you start out with the Phillips curve, which suggests if you're the Fed and you want to reduce core inflation, how much do you need to increase the unemployment rate? So the unemployment rate is that light blue line. If that light blue line goes down, that means unemployment is rising. And what we've typically seen before is the Fed needs to get core inflation down about 4% from peak. In the past, a 4% reduction in core inflation means you're going to have to increase the unemployment rate by at least 2% from the bottom in order to better match the supply and demand for labor and get wage growth to come down. And so we know that, right now there's labor hoarding going on. It's very difficult to find qualified hires. And so companies do not want to just part ways with good employees. They're going to have to be forced. And they would get forced to do that through a profits recession. So what type of downturn in profits or decline in profits or earnings is typically associated with a 2% increase in the unemployment rate? And so if you look at that dashed red line, you can see anytime we get a 2% increase in the unemployment rate historically, that corresponds with something like a 10 to 20% decline in corporate profits. And if you think from where we're at now, if you hold sort of price to earnings ratios constant, that would mean a 10 to 20% decline in equity prices required to put enough pressure on earnings and margins that corporations would feel the need to lay off employees, which would drive the unemployment rate higher, which would give the Fed more confidence that they've defeated inflation. So this is also something we spoke to in a prior video, just wanted to provide something more substantial here and sort of show our work. But that's really the relationship the Fed is thinking about. They don't want to create a profits recession, but historically, if they're trying to bring inflation down, that's just what's been required. And so profits recessions, now let's talk about economic recessions, the last factor in our framework. Spencer, any updates to our recession forecast here on the next slide?
No major changes to the recession forecast. You'll see here slightly higher probabilities from last week. That was due to some of our market-based inputs as the S&P fell slightly last week. High-yield bond spreads slightly expanded last week, that leading to slightly higher probability on the margins. One of the big new data points that we got in was the New York Fed's updated recession probability, which looks at the yield curve. And as we know, almost all yield curve indicators flagging recession risk right now. So that definitely boosting up some probabilities as well. However, still sitting pretty confident that right now we are not in recession, less than 25% probability there. And that's still primarily driven by the labor market and strength there. Until we see people really start losing their jobs, the US economy has historically been in a pretty good place.
Those are the updates for this week or the past week. It's going to be another busy week in markets. We have the CPI report, January CPI numbers coming out on Valentine's Day. We get retail sales data that will be very closely watched, particularly after the dramatic slowdown in retail sales in December. Fed meeting minutes, so we get to parse through those midweek. And then when we get to Friday, we have options expirations Friday. So expect a lot of volatility. These are all things we're excited to dig into and report back during future videos. But for now, thank you so much for watching, and we will talk to you soon.